This is a project that I started with my PhD students a few years ago. It is about the impact of ESG, environment, social, and governance components of companies on stock valuations. Let me give you a brief preview. So basically, starting with the influential article of Friedman in 1971 in New York Times, he states that the only goal of a company is to maximize profits. So the company has no goal associated with community, environment. So if the company needs to maximize, cut off trees and maximize profit, that's perfectly fine, because a company is not a citizen. It doesn't have any conscience. On the other hand, based on the stakeholder theory, in fact, a company may have obligations not only for the shareholders but also for other stakeholders, including employees, community, environment, suppliers, customers. So all the people, all the entities that are associated with the company. So you can consider a company as a lexis of contracts. There are lots of contracts. Some of them are explicit, meaning that the company promises to deliver certain goods to you. Some of them are implicit. So companies behave in certain way, and then you receive some benefits based on these implicit contracts, and then you act upon it. So in this article, we investigate whether ESG matters, and we do it in a very interesting way. We look at the stock price response to new information in the presence of ESG, environment and social governance characteristics of the firm. So in my field, we assume and believe that markets are efficient, at least to a certain extent, meaning that when a new information arrives, then capital markets react to it. For example, yesterday, there was disappointing unemployment numbers. Therefore, the markets react. The market went down by 2%.
Very efficiently, yes.
Very efficiently, yes. It is sometimes painful, but sometimes good. Like, for example, Elon Musk announces that it will take over Twitter. The stock price of Twitter goes up immediately. So it responds to it. So we consider efficient capital markets. So we examine whether ESG matters in the context of new information release, and this new information is credit ratings. Okay. So there's a growing interest in environmental, social oriented investments. So based on assets under management, so the total value of investments increased from $50 to $140 billion in just 6 years. And there are more than 2,500 asset managers signing United Nations signatory. And almost all universities in the United States work with ESG compliant money managers. So basically, when your company receives a donation and there's a foundation associated with your university in fact works with an investment manager, and that investment manager is ESG compliant, meaning that he does not invest in like sin stocks, gambling, and other things. And then he's also conscious about environment impact of the companies they are investing. Okay, we have a limited understanding of the mechanisms through which ESG may influence invest decision process. Okay? So in this paper, we asked the question: does investor positive effect of firms with perceived attractive ESG characteristics influence stock prices? So basically, I know that, or I believe that Microsoft is a very environmental friendly firm. It's a and then Microsoft released a positive news. The question that I ask here, Microsoft receives better market reaction than another company which has inferior ESG characteristics. Right? So through this, we try to assess how basically investors make decisions regarding firms. So in order to this, basically we look at the stock market reactions at the announcement day. So for event study, meaning that we look at the market reaction at the surrounding event. So we look at -1, +1, because sometimes the information may be leaked. Therefore, we look at whether there's a cumulative market return. So in summary, let me summarize our findings and I get into details. So basically, investors develop a positive halo effect for firms with high ESG scores. And they may have their positive perceptions reinforced when these firms receive positive financial news in the form of credit rating upgrade. And I'll talk about this in a few minutes. And after accounting for all relevant factors, we find that the highest quartile of ESG scores amplifies the positive stock market reaction to credit rating upgrades, so positive news, by 130 basis points. So it is 1.3%. So you may say 1.3% is not too much, right? Especially the market went down 2% yesterday. But if you
not bad, still not.
But if you analyze it, if you analyze this 1.3%, it's a huge number. So basically, and then it also helps us better understand why like environmental or social friendly firms are selling at premium prices. So overall, this suggests an important role for the investor bias of confirmation. But there's a long growing literature on the impact of ESG on stock prices, how environment and social characteristics of firms influence stock prices. And then, I mean, these are all studies, but credit ratings also influence stock price. What are credit ratings? Credit ratings is not an investment advice. It is rather assessment of companies' creditworthiness. So, for example, when Moody's assigns AAA to Apple, it says that it is very unlikely for Apple to default on its debt obligations. Okay, whereas Moody's assigns CCC to another company, then it means that this company is very likely to default on its debt obligations. So, and then investors react. So AAA is a positive news. When as soon as this information is released, stock price goes up. When there's a negative news, CCC assignment, then the stock price goes down on the day of the announcement. Okay, and then the third line of literature is about behavioral finance. It's a growing literature on the impact of behavioral biases on stock prices. There are several behavioral biases, but in this study, we focus on a few things like confirmation bias. So basically, if you believe or if you have a certain belief about a company, and if additional positive news is released, then basically you amplify your reaction. It amplifies your reaction. Alternatively, so basically the first hypothesis is basically if there's a positive news comes, then it amplifies the reaction. The second one, if there's a negative reaction in the form of a credit rating downgrade, then the companies which has positive attractive ESG attributes are less likely to be damaged. So the stock price will be less severe. for this company. So it's like it serves. I mean, we test hypothesis whether these ESG attributes serve as an insurance, so stock price doesn't go down. That's what we are going to test. So we get our data from commercial sources. So in finance, we are lucky to have objective data, and so we got it from MSCI, and we got credit ratings from Bloomberg. We got firm characteristics and stock prices from Compustat and CRISP, respectively. So we look at cumulative return 5 days before and 5 days after. So this is the accumulation of market reaction over 11 days. Okay? Why? Like, you know, -5 + 5. We look at -2 + 2, -1 + 1. The reason is that it is possible that investors, I mean, some information may be leaked before the release, and also some investors may get this information. They may assess this information before the actual information is. Therefore, we look at -1 + 1 just to make sure that, you know, there might be some leak of information. So we have 454 upgrades, credit rating upgrades, and 457 credit rating downgrades in our sample. These are the primary results for hypothesis 1. So we look at what happens to market reaction, cumulative minimum return, based on company characteristics, including company size, profitability, debt level, mark-to-book ratio. It is the ratio of market value of the company to the book value of company. It tells us the growth opportunities of the company. And then the magnitude of notches, how many notches there's an upgrade. So it's just 1 notch, 2 notches, or 3 notches. And then we sequentially add year fixed effects, industry fixed effects, and firm fixed effects in our regressions. And then we donate 10% significance with 1 star, 2 stars represent 5% significance, and then 3 stars represent 1% significance. So we have a high ESG dummy, which takes the value of 1 if the company is in the highest ESG quartile and 0 otherwise. So the first regression, where the dependent variable is cumulative return, market reaction to the announcement, is positive, 1.5%. So this is accounting for all the other factors. And then we add year fixed effect, industry fixed effect, and firm fixed effect sequentially. We continue to find a positive and significant effect. And this 1.5% is economically significant as well. So the company's value goes up by 1.5%. If you analyze, it's a huge number. And then we look at the second part of the hypothesis, hypothesis 1b, and examine what happens when the company releases a negative news in the form of a downgrade. And what we find is that when we control for, like, we don't have any year fixed effects, industry fixed and firm fixed effect, it is negative. So it means that in fact the investors are punishing the company with negative news when they have high expectations about the company. But that effect is not robust, so it goes away once we add industry fixed, year fixed effect. And then when we have industry, there's some, but when we add both, then it's washed away. So it is not very consistent. We conduct a number of robustness tests, including we drop the observations with cross investment grade boundary. So it is possible that so the companies has investment grade versus junk bonds. Investment grades are basically very high quality, and mutual funds and money managers typically invest in those bonds. So we drop those observations. We continue to have similar results. We look at different event windows, 3 days, 2 days before, 2 days after, 1 day before, 1 day after. We continue to find similar findings. And then we look at different CAR methodologies. So it is important that the methodology is built upon the fact that the news is unexpected, and the market reaction, unexpected market reaction. It is very important. If market, if market expects 2% increase in stock price, and the actual stock price goes up by 2%, this is not abnormal return for us. So whatever we are finding here, it is on the top of what market expects. Okay? And then we look at varying high ESG methods, low ESG continuous scores. We don't find anything for that, and we have a good explanation for this. And then we'll examine different components of ESG. So ESG refers to E for environment, S for social, G for governance. When we look at subscores, environment only, we don't find any results there. We look at S, we don't find any scores there. So basically, our interpretation for lack of evidence is that investors, in fact, focus on overall score. Rather than going into details and trying to understand each company, they focus on overall look of the company. And then when we examine the continuous ESG score, we don't find anything there as well. So which reflects that, in fact, investors look at the top echelon. They don't care, like, where you look, but it is, as long as you are in the top echelon, it is the most valuable one. And we don't find anything for the low ESG score. So basically, the investors are paying more attention to the top ones. In conclusion, this study adds to literature supporting a high ESG score as a significant factor on how investors respond to new positive information, and this influences stock prices. And this only influences high quartile of ESG scores positively moderates the reaction to credit upgrades by 130 basis points. And this is consistent with the idea of confirmation bias. So investors incorporate high ESG into decision making in the presence of good news upgrades without any effects for bad news. It also contributes to research on the confluence of effect and invest decision making. In particular, halo effect for high ESG firms influences the weight afforded by investors to new non-pecuniary information. And salience also plays the important in how investors pursue information relating to ESG. So basically, measures that appear most prominently, overall ESG scores and ratings, as well as the most extreme categories, so highest echelons, most impactful on behavior. So last but not the least, third-party influence investor perceptions of high ESG characteristics may influence near-term equity demand in the presence of new information, new positive information. So basically, what we find is that when investors have confirmation bias about a company, for example, let's say that I highly admire Microsoft based on its environmental friendly policies. But when there's a positive news, not necessarily related to environmental performance, but rather something more pecuniary, more monetary, then investors react to this information. And then they react positively. So this is our research with Brian. Please let me know if you have any questions.
All right, thank you for the presentation. Okay, I have a question. Are you familiar with Aswat Damodaran? This is an NYU professor. He has frequent appearances on CNBC.
Yes.
So I've listened to a couple of his broadcasts. So, and he's adamantly opposed to the value of ESG. he says that there's no the impact or all this, almost like a
Greenwashing.
yeah,
Yes.
like it's
Yes.
gonna go away or
Yes.
something like that. So there's no substantial value behind this. I mean, I didn't look into his data, but yeah, what do you think about it? Is it really a substantial impact, or is it like more superfluous, where on the surface rather than this? Because for long term, you expect to have a substantial changes in the company in terms of profits, right? So what do you think
Yes.
about that?
So this is a long ongoing discussion in finance. So there is mixed.
It's also a politically charged topic, so it's difficult to study,
Yes. So so there are some. I mean, finance literature or finance academics are opposed to ESG for a long time. In fact, I am one of the first people who published on this issue. And on the positive side, the evidence is mixed, but it doesn't mean that it is absolutely bad or it is absolutely good. Or so basically what we find is that under certain circumstances, investors value ESG. So, and then we also find that companies select their ESG attributes very carefully. For example, GameStop. What does GameStop do? They sell games, right? So basically, GameStop supports institutions that helps children who have addictions to games. So if you are a parent and if you want to buy a game for your child, and if you know this, would you go to GameStop or would you go to Target? Okay. And then we know that some of these issues are highly related to performance. For example, and these things come hand in hand. So if you improve your relations with your employees, it's also stakeholders, okay? And so it improves their performance. It decreases your turnover rate. So you have higher productivity. So this is the very reason that Costco does not lose its employees, whereas like there's a high turnover rate of employees at Walmart. And then people, especially like wealthy people who can afford it, so they value these products and they can pay premium, like when they buy products. Okay? Of course, it is not the score has not been settled yet. However, there are studies which confirm that ESG, the impact of ESG is non-trivial, and it has a huge impact on not individual investors but also on institutional investors. So I'm not saying that ESG is absolutely good. I think when I make an investment, I look at ESG components in a selective way, see whether the company is like, use it in a smart way. Another example, Sonic restaurants. 70% of Sonic restaurants are owned by franchisees. So, and these are both Democrats and Republicans. And Sonic restaurants is driveway restaurant. It's quite popular in South. So I met with the CFO of Sonic, and I asked what type of ESG activities they do, and he said two things: education and art. These are issues that all of their franchisees agree on. No matter you are Republican or Democrat, you support good education. So that's what they do. And so these are things that are important. And companies are successful to the extent that they do it in a good selective. Like, for example, when you go to Target, what's the first thing that you see on the back? You said we support community and we make so much donations to the community, right? And especially it is very important for new generation. That's what the results tell us. And Necmi Hocam, you have a question?
I mean, it was I think you already answered around that. So it's highly political influence topic, I guess.
There is a very interesting article recently published and on the political affiliations of CEOs and then ESG characteristics of the firms that they are running. So Republican CEOs are less likely to donate money to charities than especially on environment, and then whereas like the Democratic ones are more likely to make donations.
I have a couple of questions. Maybe you answered half of them. One of them is about the confirmation bias.
Yes.
Could you please go to the results for primary results for hypothesis 1?
Yes.
So in this panel B, for the downgrades, you don't find a significant relationship with the companies. They have their high ESG.
Yes.
When they have these negative news, when we
Yes.
have the downgrades. So is this about again the confirmation bias? These people have, maybe they have some ideas about these companies because they have already high ESGs and they ignore the news about the downgrades. And how do we measure these people's evolution of their information stream? So when they start with at a point, they really know this firm is having a high ESG, and they are influenced by other news throughout the years, and this company now is not at that stage. Or it can be just vice versa. A company starts very poor and then starts with getting better over the years. I think the second scenario is more possible now. So how do we measure at these changes and how investors are basically changing their ideas about the firm?
Okay. So the first part, actually, let me start with the second part of the question. So here we have an event date, such as, let's say, June 10, 2021, and we get the most recent ESG component prior to June 11th. So let's say it was released in May, and that's what we use. So we only know, so that investors, when they assess this new news, they look at the most recent one prior to the release of this information. So in this study, we don't look at how the investor's decision or assessment evolves over time. It's a different issue. It's a very important one. I agree with you. But in this one, we just look at the assessment of the company's ESG, and it is done by third parties, such as Morningstar. Okay? And then so investors look at it and then see there's a new information coming up, and then we assess whether they are over or underreacting to this news. Regarding the first question, it is important to note that, like, when there's a positive news, the average market reaction is positive. Here, what we are looking at is on the top of 2% positive news, is there an additional impact of high ESG? And that's what we find. When we look at the downgrades, average market reaction is negative 2%. And we are looking at whether ESG alleviates this negative 2% to 1.5%, or maybe make it even worse to 2.5%. So in the presence of confirmation bias, if there's confirmation bias, then we should observe that it should be 1.5. So negative 1.5. So that it should elevate, because the investors will overweight their belief about the ESG and underrate the new information. Therefore, they react less to negative information. But that's not what we see here, at least for downgrades. And so basically, our overall assessment is that when, like, you know, there's a selection bias. So when we look at the news, the company, confirmation bias is typically perpetuated by good news. So when there's a good news, then you perpetuate and then you overreact. But we don't see it for the negative news. That's our findings for this paper.
Maybe it is just related to human psychology, right?
Yes, exactly. Yes. So basically, you know, I have some friends who made investments in year 2020 in stock market in March, and they made like 30%, 40% return over 6 months. And they say, you know what? I'm an expert on this. But no matter what you invest in March 2020, will generate a return of 40%. Okay. Yeah. And then, however, last month, they lost like 20%, or market is down.
It's not because of me.
Yeah, it's not because the market is down. So this is human nature. This is human nature. So we attribute good things to ourselves and negative things to others.
Yeah.